Hi, thanks so much for joining in. You're watching Your Money Matters on NDTV Profit, and my name is Alex Matthew. This show gets you answers to all of your personal finance questions. Whether that is saving and investing or spending wisely, we've got you covered. And today, I'd like to talk to you about a category of mutual funds that has been gaining a lot of traction. And I think the reason why it has is because of one of its allocations. I'm talking, of course, about the multi-asset category. And in the recent past, there are a few schemes from this category that have done incredibly well because they have an allocation towards gold. Now, even those schemes that had a significant allocation towards gold at the start of this year have reduced their allocation as gold prices have gone up. But the result is that the one-year performance of some of these schemes stand out and compare even quite well with even pure equity schemes. We'll talk about how this category is performed, how you should plan your investments in it, and whether you should run after recent performances and add them to your portfolio. Joining me today is Mohit Gang and Vineet Iyer. Both of you, thank you so much for taking the time today. Mohit, let me come to you first, just to give us a roundup of how these schemes have performed in the recent past. And I think a 1 year and a 3 year time frame would be good to look at.
Yeah. Thank you very much, Alex, for having me on the show. And as you rightly said, I think this category has kind of stood out for its last 1 year performance and has also caught on to the fancy of investors just because of the kind of investments the category is allowed to make. So look quickly, as per SEBI's definition, the category has to invest minimum 10% into three assets: equity, debt, and commodities. And as these categories, as these funds stand today, most of the funds will have an equity allocation around 65 odd percent, some a little less than that for the tax advantage. Debt would be around 25 odd percent, 25 odd percent, and commodities is one allocation which has swung heavily in all these funds, and you can see major differentiation across the funds in the commodity allocation, which can range anywhere from 5% to as high as around 25-30 odd percent also in some funds. As long as performance stacks up, I think the range is from a 3% performance for last 1 year to as high as around 15-16 odd percent for 1 year. And the category average, I think, or the good performing funds stand around 15% to 11 odd percent range. So that's been the last 1 year performance, which is much higher than what your Nifty has delivered or a mid cap index or a small cap index has delivered in last 1 year. And that's sheer because of the gold weightage and also because of the fixed income weightage in these schemes, Alex.
Yeah, and the reason why we are focusing on that 1 year time frame is that quite a few of these schemes don't have a lot of data. They're not very old. So I want to come to you, Vineet, on what Mohit was saying and talk about the way that different schemes in this category have varied approaches to constructing their portfolios. There are some, as Mohit pointed out, that have a significant commodity allocation, and by commodity I'm specifically talking primarily about gold, and those that don't. How do you describe them? Would they fall into three broad buckets?
So if you actually, first of all, thank you for having me here, Alex. If you actually look at how this category has panned out over the last 3 years, I've got some data points here. So 3 years ago, there were only about 8 funds in this category. And in the last 1 year, this category has zoomed from being 8 funds to about 30 funds now. And one of the reasons why I see there is a increased interest in this category is because one of the pioneers in this category being ICICI Multi-Asset Fund, which they rechristened from a ICICI Dynamic Fund back in 2018. They are now getting about 1,200 to 1,300 crores of SIP every month, which means that there's a good amount of flow coming in. And the industry feels that when there is volatility, they have to come up with a new theme to attract new flows. So I've seen that this has actually encouraged most of the AMCs to come up with this category. And there have been widespread performances of the mutual fund schemes like what Mohit rightly suggested. And depending upon the gold allocation, there has been outperformers as well. For example, if you look at White Oak, which had typically 20% of allocation to gold, which was one of the highest in its category, has kind of outperformed in the last 1 year. In terms of the performances, the returns that it has generated is about 15%. At the same time, if you look at something like a Shriram Finance, which actually took that call wrong in terms of not having a very significant portion into gold, they ended up delivering about a 1.8% negative return. So if I have to put into bucketing system, people who have got the gold call right, they have significantly outperformed the benchmark as well as this peer group. And fund managers who did not get this call right, of course, they have underperformed.
Yeah. Mohit, just to drive home this point, right, because ultimately, by my understanding, you need to have 3 assets at the very least in a multi-asset category. Otherwise, if you don't have commodities, if you don't have a significant allocation, and here I think you can throw in infrastructure, you can throw in real estate, you can throw in a couple of others, but real estate mostly through real estate investment trusts, and we'll come to that question in just a bit. But if you're not doing that and you're primarily allocating in equity and fixed income, then you're not truly different from a balanced advantage fund or certain other funds in the category, right?
Yes, Alex, I assume this question is to me.
Yes, Mohit, it is to you.
Yeah. So look, yeah, you're absolutely right. If it's only equity and fixed income, then it's like any other balanced advantage fund or a balanced fund. If you put in commodities in the mix, and which is what most of the fund houses have very astutely played on in last 1 year, which Vineet also alluded to. I think the entire mix changes, the entire risk reward matrix changes, the complete dynamics changes. Look, a white oak having almost so they have reduced allocation, but they went as high as almost 30%, if I'm not wrong, or 25% in commodities. They've now reduced it and trimmed it. But having gold and silver both, and there are fund houses which have also gone more aggressive on silver, has kind of changed the return profile in an year when equities were almost down, flat, or negative in some cases. Also, these schemes by nature can have REITs and InvITs. They have around 5 to 7% allocation. Most of the fund houses will hover around 5% combination of REITs and InvITs, which also has kind of stood out because that gives you a fixed return on the overall portfolio as compared to equities which have just not given anything for last 1 year. And one important allocation category which also is a part of some of the multi-asset funds is the international allocation. If you see, Alex, there are few funds which also does around 10% odd allocation into international stocks, which also has kind of given a positive boost up to those performances. So the category is very varied. Any investor who's getting into this category needs to dissect it completely and figure out what exactly does he want, what kind of asset class does he want to hold, and what kind of risk profile of the fund does he want to get into.
Yeah, it's an important point. So let's take that forward. Before we get into some of these allocations and how the strategy has differed, particularly with commodities. And I do want to drive home that point on silver because there's one scheme in particular that has gone overweight in the recent past on silver. In fact, we spoke with the head of that organization not too long back, and he did mention that they were doing it. But Vineet, a lot of people have gravitated towards multi-asset to shore up their allocation towards gold. Maybe that's that, or maybe they heard in the media, or they heard from their peer groups that this particular category was doing well, and that is because of gold to a large extent, as Mohit just pointed out. Do you think that the reason why people are getting into the multi-asset category may not be what should ideally be the case?
Sure. So typically, Alex, if you see, investor is like a herd mentality where, if something starts picking up, people would queue up in terms of getting exposure to this. And AMCs are also played out smartly by projecting the category where they are kind of focused most on the gold part. But in reality, if I look at the trend of gold allocation in the multi-asset category, that has not typically gone beyond the 15 to 20% mark. And although, it has been rated like a gold significant allocation. And if I look at the last 12 months trend in terms of the gold allocation, that has been coming down significantly. And today, if we see something like an ICICI is just holding about 3% odd, 6.5% odd with physical commodities and ETFs in gold, and silver also they're barely maintaining about 3%. So I think it's mainly the way the asset class has performed, and that has kind of boosted the multi-asset category in terms of attracting investors, is what I think has played well.
Okay, so let's talk about that gold and silver, right? Because, and I was referring to Quant, which has said that because of, and when we spoke to Mr. Sandeep Tandon, he essentially spoke about the gold-silver ratio. And it must be said that since that point, that gold-silver ratio, which effectively talks about the ratio between the price of gold and the price of silver, which at the peak was at 103 or thereabouts, where the equivalent of the same weightage of silver would you'd be able to buy 100 units of silver from the value of that 1 unit of gold effectively, right? And that has come down quite dramatically because silver prices have gone up, Mohit. But what would you say about that allocation and the way that fund houses have played this commodity allocation?
Look, Alex, I think one word, kudos to the fund manager and the fund house to have identified this opportunity. And it requires a lot of gut and gumption to play this kind of a strategy. It's not very easy in Indian mutual fund industry to stand out of the way or out of the crowd and do something of this sort. Having said which, most of the fund houses did take a silver allocation, and they kind of increased the allocation also, but minutely. No one went oversized on silver, and you rightly pointed out the silver gold ratio was around 103. It's now currently standing at around 86. If you check historical levels on silver, that's still very high. The historical levels kind of give a ratio of around 65 gold to silver. At 83, it's still very high, but that also means that gold prices can come down, not necessarily that silver prices go up to match the ratio. Right? But again, these are all tactical calls which perhaps fund managers can take it right on their account. But most of the multi-asset funds otherwise have a silver composition between 2 to 4% or at best 2 to 5%, other than the fund which you mentioned, Alex.
Yeah. Let's take a bit of a sidebar, Vineet, and talk about gold and silver, because ultimately that has been the focus of a lot of investors over the course of the last 1.5 years. And we've enumerated several reasons why gold and silver have done well. I think it's important to note that silver derives quite a large amount, 60% of its value, from industrial usage, and only a 40% or thereabouts from the investment angle. And it's interesting also that a couple of central banks, one in particular, has started keeping a silver reserve as well. But what, according to you, are the reasons why we've seen the rise in gold and silver prices, and do you anticipate that that is likely to continue?
Right. So first of all, I will talk about why silver is actually making so much of news. It's primarily because, like you rightly pointed, about 60% of the use cases is industrial for silver. And if I give you some stats, in 2024 alone, one of the best use of silver is to create the solar PVs. So the growth in solar PVs has actually increased the demand for silver by about 31%. So if I look at the numbers, it was about 257 million ounces that was required. And by 2030, it is estimated that approximately 546 million ounces would be required of silver for solar PV alone. And if you look at the countries which are going to be demanding this, China stands out, where they will be requiring about 20% of the total demand of silver by 2030, followed by India and US. Apart from this, if you see, the production of silver has been going down consistently. So over the past 5 years, the demand has been more than the production. Partly it is supported by the recycling that the industry has been doing, but it's not been meeting the demands at all, because of which also the demand being higher, supply being lesser, the price has kind of enhanced. If I talk about gold, gold historically has outperformed whenever there has been uncertainties both on the economic side as well as the geopolitical side. And we have all seen in the past 3 years, starting from the Russia-Ukraine war, how there has been a lot of geopolitical uncertainties. In the last 1 year or so, we are seeing a lot of economic uncertainties because of the US trade tariffs. And basically, these uncertainties have resulted in terms of people flocking to gold. A lot of central banks are now increasing their reserves, including India, China, Turkey, Poland. These are all stacking up on gold, although the pace of stacking up has gone down. So we might see some reduction in demand by the central banks. But of course, the retail demand is kind of going up. So these are the two things. And the third thing, why gold might continue to increase, is because of the focus of US on weakening the US dollar, which means that if US dollar is weakening, of course, the demand naturally will go for gold.
Got it. Okay, and that's very well explained. Let's talk about ultimately what an investor should do. Mohit, you referred to their risk profile. And this is important to bear in mind because we've already described different strategies that are employed by fund managers in this category. So when you are going out to invest in these, should you watch for the way that these are constructed? Because it is possible that the tax treatment in a multi-asset fund could be different as well. Some could have an overweight on equity and so therefore will give you an equity taxation, while others will give you that 2-year long-term capital gains tax of 12.5% or thereabouts, right?
Yeah, absolutely, Alex. Look, I think each investor has to determine what his risk profile is and what does he ultimately want to achieve by having this fund in the category. To answer on front of diversification, look, I think if there is a category of investor which doesn't want to actively get involved in allocations between equity, fixed income, commodities, so on and so forth, and he's confused between all these categories, then multi-asset gives him a great choice. It's like a buffet served right in front of you, and you can then and I think that also you don't have to manage, everything is in your plate, right? So you just have to pick up the plate. And from a taxation point of perspective, if an investor is looking out for equity taxation, then yes, he will have to do his due diligence to figure out which funds out of these are keeping a weighted average equity allocation over 65%. In that case, yes, the taxation is 1 year long-term capital gains taxed at 12.5%, and even then 1.25 lakhs is exempt, the first 1.25 lakhs of long-term gain, and short-term is 20%. But if your equity composition is between 35 to 65 odd percent, then the long-term definition changes from 1 year to 2 year. The taxation remains 12.5%, but the short-term gains are taxed at your marginal rate or the slab rate. And if there is a fund which has equity lesser than 35%, then it will be taxed as debt funds. But to my mind, there is no multi-asset fund which is taxed as debt fund right now. But you have multi-asset funds in the second category, which is equity allocation hovering between 35 to 65. So an investor, if he's not looking for a safer profile, but if he's looking for a equity kind of product or a synthetic equity product, which also gives him the benefit of equity taxation, then you have to be extremely careful to select a fund with over 65% of weighted average equity allocation.
Yeah, important point. And by the way, there are schemes in the category, and Edelweiss, for example, comes to mind, where they use arbitrage in order to meet that threshold of equity taxation, right? Or at least they have a larger allocation towards equity, not necessarily pure equity. They have arbitrage, which does not give you necessarily the same equity returns that you can imagine, but it does give you better than fixed income returns. So therefore, Vineet, in your opinion, and coming to the brass tacks, if you have to add some more to this, would you say that the allocation depends on, of course it depends on the investor, but what they have in mind? It is of course a long-term strategy. Nobody's investing in this for a period of 6 months or a year or even 2 years. You're talking about a long-term portfolio. But where does it fit in your opinion? And what are the schemes that you like in the category and why?
Sure. So first of all, depending upon the market levels, I think an investor, if he does not want to take too much of risk, but still have the equity taxation, they can go for portfolios which has a larger allocation to arbitrage, where they are protecting the downside. But of course, if the market starts zooming up, then you don't get the upside. But this is somewhere for someone who is kind of risk averse. But people who are okay with risk taking, then they can go for equity heavy, with of course the remaining amount going into a diversified commodity oriented allocation between gold, silver, and a couple of other REITs and stuff like that. To my mind, a multi-asset fund looks well for a 3 to 5 year horizon. And from that perspective, I think equity-oriented multi-asset fund would do well. Of course, there'll be periods where commodities would outperform, and that will give some balancing result to the portfolio returns. So anything on the aggressive equity side would be my take in the fund, and ICICI fits well in that category.
Okay, ICICI Pru, and it's, as you pointed out, one of the older ones. Mohit, you want to change anything, or you want to have a different perspective on the schemes in the category, what to look for? And by the way, I didn't ask, but recent notification from the Securities and Exchange Board of India changed the tagging of REITs to equity. Does that change anything from the perspective of the multi-asset fund?
Absolutely. I'll take the second part first, Alex. The categorization of REITs as equity will have a huge impact because now most of the funds which were demarcating REIT plus InvIT allocation to up to 10%, not just in multi-asset but in other funds also, can move the REIT allocation to proper equity allocation. So REIT will now become a part of the 65% allocation under equity category, and the InvIT allocation can also go up, which was also a combination between REIT and InvIT. Now the InvIT alone combination can go up to around 10 odd percent in any portfolio. So my sense is we will see incrementally most of these funds having more and more of REITs, not just multi-asset but other equity funds also. To answer the first part now, which is my preferred choice, yes, I will kind of agree with Vineet now that I will go into equity heavy multi-asset funds standing right now. I think the commodity cycle has got largely played out, though I'm still bullish on gold and silver, but I'll still choose a balance between the two. And my preferred choices out here would be Nippon multi-asset, plus Axis multi-asset and DSP multi-asset. I think I'm going more by a 5-year rolling return performance, and I've seen these funds kind of stand out that their average returns have always been over in the range of around 10 to 12% and even higher for a longish period of time frame. So these are my three choices.
Okay, and the final question, which is amount of allocation. Of course, the suggestion is that you have a broad idea of how much you want your equity to be, your fixed income, and your gold or your commodities, gold and silver. But in this case, you're going to add something. In all probability, most investors have multiple schemes in their portfolios. They have pure equity. Sometimes they also have a pure fixed income, or they have other hybrids. So Vineet, first to you, how would you position this as part of an investor's portfolio? And let's assume here that they're doing this not necessarily because they don't want to allocate themselves, but because they want to have diversification in their portfolio and they want a tactical investment.
Sure. So if I have to talk about the way we approach this category, we typically tend to allocate any money that is required between the 3 to 5 year zone, where we don't want to take too much of risk in the equity. At the same time, we want to also have a position in commodities they play out and kind of be counterintuitive to the equity at large. So that is the category we look at in the multi-asset space between this period.
Okay. And Mohit, so I know that you said that this is, according to you, meant for investors that don't want to allocate themselves, but what if you want a tactical investment in one of the schemes that you mentioned that is more aggressive, maybe in the commodities space? And so from that perspective is providing you with a diversification and removing the requirement that you might have to allocate towards gold and keep investing in it.
Yeah, Alex, so I get that point, and I think it will all vary from investor to investor depending on the kind of profile he or she is. So if you are a retired investor, then perhaps this category serves great purpose because it is conservative in nature. It kind of hedges by itself by virtue of having 3 or 4 asset classes within the overall scheme. So it gives you a natural hedge and a conservative way of running your portfolio. So for any kind of conservative investor, I think anywhere an allocation of 10 to 20% could be a great allocation to have. For someone who's an aggressive investor, young investor, and can manage, then perhaps the allocation to this category could be negligible or lower. But again, as I said, it will all depend from an investor profile perspective and also from time horizon. As Vineet rightly mentioned, if your time horizon is within 5 years, then yes, a pure equity play might not be a great play to go for given the scenario at which we stand currently. Then perhaps a balance advantage or a hybrid or a multi-asset is the right category for you.
Yeah, in fact, both of these gentlemen have suggested that you look at a bucketing strategy. We will talk about that in future episodes. What they mean by that 3 to 5 year time frame is to identify why you would need the money and to plan your investments based on that. Gentlemen, thanks so much for taking the time. Always a pleasure speaking with you. I think this has been an enriching conversation. And that brings us to the end of this edition of Your Money Matters. Thanks so much for listening in, and let us know what you think. Do stay tuned. This is NDTV Profit.